Welcome. I am Ernie Goss, McAllister Chair here at the Heider College of Business at Creighton University in beautiful downtown Omaha, Nebraska. Today I'm joined with Tony Hendrickson, the Dean of the College of Business, Heider College of Business here also at Creighton University, of course. And today we're going to talk about what the Fed may do, what the Fed should do, and what will be the likely outcome of the Fed's actions. As most of you know, last week the Bureau of Economic Analysis announced that the GDP, U.S. GDP for quarter one for 2022 declined negative 1.4%. At the same time, inflation for that same quarter was running at 8.9%. Well, we call that stagflation. That's the early stages. If it continues, it is a stagflation, but we'll see if it continues. But what we're seeing, of course, is the Dow Jones Industrial Average, PE ratios has come down. It's still at 19.5. It's fairly rich, and prices are down, but are they enough? Tony, are investors whistling past the graveyard? In other words, should stocks be up like this, or what's going on there?
Well, it's a really choppy market for a lot of reasons. We have, armed conflict in the Ukraine. That's upsetting supply chains. It's affecting energy, and obviously energy affects all of us in some way, shape, or form. It's an election year. We have the discontinuation of a really lenient monetary policy in which we were basically flooding the market with dollars. And now we're trying to figure out what to do about that. Inflation, what gets me is, of course, the people who are surprised that pumping this much money into the economy caused inflation. Is like, who would have thought that? I'm like, did you read any economics in your life? I mean, most of us, I think, expected that to happen. And so we have what you referenced, which so many people, I guess only people that are now older like us remember that, but you and I both remember stagflation.
Oh,
and that's a real problem for a country, and I think that even the Fed is not fully grappled with
now
that.
What's the Fed going to do next week? We all know they're going to raise rates on the 4th. Now, this is 3rd and 4th. They'll raise rates by as much as 50 basis points, maybe 25, but I think it's going to be 50. And what's going to happen then? Of course, interest rates, prime interest rate rises on May the 5th,
right?
And it'll be up to from 3.5 to 4. Now that's going from 3 to 3.25%, the prime, up to 4% now. What's going to be the outcome?
Well, I mean, I think that they want to do that. I'm not sure I disagree with that in terms of how it's going to address inflation. But the problem they have is classic stagflation. We've got to get inflation under control. 8.9% is pretty severe. It's the largest in 40 years.
More than four times the target.
Right. And so
we call that a big miss.
That's a big miss, and you have to address inflation, but there's no way you're going to be able to raise those rates and put the brakes on inflation without getting some stagnation of growth. And then they want to have continued growth. You can't have your cake and eat it. You're going to have to pick which side of the equation you're going to work on.
And our surveys that we conduct here at Creighton University have been pretty good, not bad. Job growth is reasonable, but now inflation's, of course, very high. And so what are investors? I mean, a lot of folks are tuning in today. Here at Creighton University, we have the investment panel that you put on every year. So people are coming from all over the globe here to Creighton to talk about where they should invest. Well, let me give you what I see investing. I think right now some recommendations, not necessarily investment. Borrow now at these fixed rates. Don't wait. Borrow now, and don't borrow at variable rates. And if you're going to borrow variable rates, make it between 1 and 2 years. Nothing more than that. So that's one of my recommendations. You have?
Yeah, if you're in the market for a new home, buy now. Don't. Some people I think are hesitant. Well, the rates have gone up considerably, almost doubled from where they were a year ago.
$382 a month is the average increase in the monthly payment on a median home across the U.S.
Right.
For the interest alone.
Right. Rents
Ooh,
have
God.
gone up 22% in the
Absolutely.
last year. And so I think if you're waiting for those rates to go back down to what they were a year ago, you're making a mistake, because I don't think we're going to see those at least for some period of time.
So buy now, borrow now, fixed rates. Okay, that on the homeowners.
And in terms of investing, we're still pretty much value investors here.
Okay,
And
absolutely.
I think investing in good companies that there for the long term, I think the long term is still very robust, but we have these problems right now, which is inflation, and that's going to cause growth to subside.
So growth stocks we call that arithmetic. You run the numbers out when inflation's running and interest rates are rising. Growth stocks are punished, and we
Right.
see that, and they will be punished, and they will continue to be punished by higher. Those are growth stocks when your earnings are out there. Value stocks, not as much, and some of those will do quite well. I have another investment idea: buy the I bonds. I bonds, U.S. Treasury I bonds. You get over 9% interest right now. 9% interest, and it adjusts for inflation. Now you can only invest $10,000. Now that's for you and your spouse. Your spouse and your kids can invest $1,000 each year. So not a bad investment. And if you're going to buy, and as you say, buy value, don't buy growth. Well, I should say don't buy growth. Some growth stock will be okay, but growth stocks in general, like the Qs, I wouldn't invest in the Qs right now, the NASDAQ ETF. I wouldn't do that right now. And it's suffering as we speak. So where would you park your cash, though? Everybody's looking at where you're going to go for cash. If you got cash, right now, Americans are, if we can say, cash rich, but they got a lot of cash. Where are they?
I think the only thing I think you can invest in is move more towards hard assets of some kind that will be an inflation hedge. And cash is you don't want to have very much cash at this point, because you're losing 9% annually.
I can cut that down a bit. If you got cash on hand, you don't have a hard asset to buy, put it in a 1 year or 2 year treasury. Nothing longer than that. Hold to maturity. Now you got to hold it to maturity. You'll get punished if you don't. So if you hold to maturity, you're getting, say, 1.75 to 2.5%. Depends as we speak today. Put as much as 2.5%, and hold it for 2 years. You'll at least cut your losses down from inflation. So that's if you don't have a hard asset to buy, that's a recommendation I would make, and that's a recommendation I'm taking in my own limited investments as we speak. So, so next week the Fed's going to raise rates.
They're going to raise rates, and I think they're going to go 50 basis points.
And now Warren Buffett said, "Don't listen to economists." He said that in last week in the Wall Street Journal.
He's a smart guy. I never listen to economists.
I don't either. I don't either. So, but we can, if you're talking about a forecast, no, there is no. But we can say the direction of the economy is slowing down. We are seeing slower growth, and the Fed's going to get inflation under control, but it's going to punish the economy in the sense that growth is going to slow.
Growth has got to slow. I even think that I'm not predicting recession, but we're going to get fairly close to that if we're going to have to, if we're going to get inflation under control.
That's right. There you heard it, folks. That's it. Tony Hendrickson, Dean of the Heider College of Business here at Creighton University. Ernie Goss, McAllister Chair, also in the Heider College of Business here at Creighton University. Until we meet again, may your economic cup runneth over, and thank you for joining in.